23-1 is called Forming a Partnership. We have two learning objectives. You need to be able to journalize entries to record investments by partners, and you need to be able to journalize entries to record withdrawals by partners. Now, we should know this. A partnership is a business with two or more persons that combine their assets and skills. A lot of times we think of a partnership as just being two people, but it can be more than two people. Oops. Each member then of the partnership is simply called a partner. Here it gives us the different forms of ownership. The three main forms are sole proprietorship, partnership, and corporation. And then it also talks about advantages and disadvantages. I would really look over these for the test so that you know. I'm not going to read through all of them, but just some good ones to note. Like when we talk about a sole proprietorship is one owner. They have all of the control. It's really easy to form. They get all of the profits, but those disadvantages, big time disadvantages, is the unlimited liability, meaning the person that owns that business is in charge of all of those debts of the business. Partnerships, those are pretty easy to form as well. It's nice that you can share the work with a partnership. Especially if you don't think that you have all of the skills needed for an entrepreneur to run a business. You might be able to find a partner that has those skills that you lack. So that's a great thing to do. Again, you have unlimited liability for that. And then you also have to share the profit. So unlike a sole proprietorship, you have someone or multiple people you're sharing your profits with. Corporation then, a corporation is going to be the hardest one to form. It's expensive to form a corporation as well. And then another disadvantage is that you have double taxation because you're actually taxed for the income as a business and then everyone that makes money from that business is taxed again on that money. Okay. A great advantage though of a corporation is limited liability. You're only going to lose money that you put into the business. And then it also has unlimited life. Unlike a corporation or unlike a sole proprietorship or a partnership, if someone dies, those businesses end. With a corporation, that business doesn't end. The shares are just sold on to somebody else. When you start a partnership, really the first thing that you should be doing is creating a partnership agreement. And that's just a written agreement that sets forth any conditions of the partnership to operate. So who's in charge of who, or who's in charge of what, how much money each person is putting in, how much money they'll receive or percentage of profits. Legally, that partnership agreement can be written or it can be oral. However, it's really a good idea to have a written agreement so that there's really no misunderstanding, so that you can go back to a document that has it in writing as to what that agreement was. So in your written partnership agreement, these are some things that you probably want to include. Obviously, the name of the business and who the partners are. You want to put down how much each partner is investing in the business. You also want to put down duties and responsibilities of each partner so it's very clear as to who is in charge of what things. How those profits are going to be divided up, and then with that, how any losses are going to be divided between the partners. You need to write in what happens if a partner is to die, what happens to that business or their partnership part, how the partnership is to be dissolved, and then also the duration of the agreement. So maybe this is just a 3-year agreement, and then you're going to look through things again and maybe make changes. So now we're going to deal with the initial investments of the owners. So it says on January 1st, we received cash from partner Sarah Hatcher as an investment, $20,000, receipt number 1. So this is pretty easy. We've done this before. It's just now we're dealing with 2 different owners. And so we're going to have 2 different accounts for them. So here we're going to increase our cash with a debit of $20,000. And then we're going to increase Sarah Hatcher's capital with a debit or a credit of $20,000. We're receiving cash, so this is going to go into our cash receipts journal. We are again debiting cash for $20,000 and crediting Sarah Hatcher capital for $20,000. Now, also on January 1st, we received cash $17,000 and office equipment valued at $3,000 from partner Parker O'Reilly as an investment receipt number 2. So notice that the total of those two numbers is going to be 20,000, and that's what Sarah Hatcher invested as well, except with Parker, he invested 17,000 of that in cash, and then the rest of it was investment of equipment. So here we're going to debit our office equipment of 3,000. Sorry about that. And then we're also going to debit cash for 17,000. So we're going to have two different debits there. And then we'll credit his capital, Parker O'Reilly's capital, for the total of 20,000. So again, we're going to our cash receipts journal. We are going to debit cash for 17,000, and then we are going to debit office equipment for 3,000 and credit the capital for Parker O'Reilly at 20,000 for the total. Now we're going to look at the withdrawal of cash for a partner. So on January 15th, Parker O'Reilly, a partner, is withdrawing cash for personal use, so $750, check number 12. So he's taking out money. Remember, we're going to keep that in a separate account called drawing. So now we have a separate account specifically for Parker O'Reilly's drawing. So we're going to debit for $750, and then we're going to credit our cash for $750 since we're losing cash. That's going to go into our cash payments journal. We're going to debit the Parker O'Reilly drawing for $750, and we're going to credit cash for $750. And then on this one, they're withdrawing supplies instead of cash. So on 7/15, Sarah Hatcher, a partner, withdraws supplies for personal use, $450, memorandum number 1. So again, we're going to debit drawing to that specific partner, Sarah Hatcher, for $450, but this time we're going to credit supplies because she's taking out supplies instead of cash for $450. So since this is not dealing with cash, this is going to our general journal. We're going to debit Sarah Hatcher drawing $450 and credit supplies for $450. All right, audit your understanding. Number 1, list at least 3 items that should be included in a partnership agreement. Remember, there was a whole list of things that you should include. You just need to list 3. Here is a list: name of the business and partners, investments of each partner, duties and responsibilities of each partner, how profits and losses are to be divided, what happens if a partner dies, how the partnership is to be dissolved, and also the duration of the agreement. Number 2, which accounts are debited and credited when a partner withdraws merchandise from the partnership? Now, we actually didn't see this one because we worked with supplies. This is withdrawing merchandise. So in this instance, the partner's drawing account is going to increase with the debit. That would not change. Whenever they're withdrawing, we're always going to increase the drawing account with the debit. But our purchases account is going to decrease by a credit. So we're taking out our merchandise. So we're going to decrease purchases with a credit. Okay, you can now move on to your 23-1 work together.